Welcome to Metcalf Money Moment, the podcast. Unlock financial clarity and confidence with expert insights to achieve your goals. Hosted by Jeb Graham, Ethan Hutchison, and Eric Wymore. Each episode offers decades of combined expertise in wealth management, retirement planning, and more. Join us for practical strategies to inspire your financial journey. Now your hosts.
Welcome to Metcalf Money Moment podcast. My name is Jeb Graham, here with Ethan Hutchison and Eric Wymore. How are we doing today, guys?
Doing well. Good morning.
Good morning. So I guess it is a good morning. Raining here in Kansas City. By the time people actually see this podcast, hopefully it's sunny and about 75 to 80 degrees every day. And we've got spring coming with less than 25 mile an hour wind. And that's
perfect.
Springtime in Kansas. So, today what we want to talk about is, something that I think is kind of personal because we go through this a lot as financial advisors working with clients, which is helping them kind of navigate, their emotions, and whether it's their emotions and just their money, when markets are in times of war and uncertainty. And when we say war and uncertainty, the two that we're talking about is obviously, as of today, we're in a war. Another thing that we have going on this year is we're in a midterm election year. And both of those things create a lot of uncertainty. And so today, I think what we want to talk about is just kind of, things that you can do with money during that time, and also maybe some myths, or whether it's myths, but really just start looking at the data. Because I think one of the questions that we get from a lot of people during times of uncertainty is, should I be doing something different with my money right now based on what is going on in the headlines? By the way, it's a very fair question, right? Because when you think about it, the news is very loud, and they're designed to be loud because they want to get clicks and they want to have people continue to watch. And so what we want to do is really kind of differentiate, kind of what the headlines would say versus what the data says on some of those things. So today we're going to go beyond the headlines, and we're really going to kind of dig in to data. And I'm going to drop just a couple of statistics that, that I grabbed this morning about war and about geopolitical events. And that's number one is that of the 20 major geopolitical events back to World War II, stocks fully recovered within an average of 47 trading days, with an average drawdown of just 5% during those geopolitical times of uncertainty or wars, basically. And then 83% of presidential election years since 1928 have produced positive S&P 500 returns, averaging 11.3%. And we're going to basically what we're going to do is Eric's going to dig deeper into markets during times of war. And then we're going to come back to me and talk a little bit about, election years, whether it's a presidential election year or a midterm election year. And then Ethan's going to wrap us up with, from a client's perspective, what should you be doing during these times and what are the right reactions? So, Eric, let's dig into times of war here.
Yeah, absolutely. Yeah. And I agree with you, Jeb. It's not exactly the most fun topic to chat about because, nobody really likes conflict, but it's something, since we are human, that does happen. And I think, we want to start off by making sure that if any listeners are there or any listeners that have loved ones that are in service, we certainly appreciate their service, and hopefully, this thing comes to a resolution real quick and no one gets harmed. But, conflicts do happen. And I think as an advisor, you're kind of looking at, history, and we'll use, obviously there's the famous phrase, history doesn't repeat itself, but it often rhymes. And you go back to look at past events and what happens and what's the outcome, and usually give you some kind of guidance for this current event. And I think, typically what you'll see is some kind of, like you said, headlines pop, right? All of a sudden the what if scenarios start brewing in people's minds. And there's this big fear sensation that comes across people, and it's so easy to sell, portfolios with clicks of buttons right now, and you can, eliminate or sell your entire portfolio, and And that kind of continues to escalate, and all of a sudden the market drops significantly. And then, cooler heads start thinking about things through, and maybe it's not as bad, and the markets recover. And that's kind of the trend line, and that's kind of the pattern that typically happens. And, a couple of these major events that have happened in the past, I mean, if you look at the Korean War back in the 1950s, instantly dropped, low single digits or double digits, 11, 12, 13%, somewhere in that neighborhood. In just a couple of weeks, had that kind of a drop. And over the next few months, it completely recovered, but then also went on to have like a 20 or 22% return during during the war. And I don't think we're certainly not saying that you have to have war to have a positive market, but that was certainly an outcome of the Korean War. Another event that happened that, maybe this is kind of similar to it, where you have a Cuban Missile Crisis, where you have immediate drop of 7 or 8%. We're on the brink of, disaster. Cooler heads certainly prevailed there. There was some, obviously in the next couple of weeks, the market had recovered. Another one that comes to mind is the Gulf War in the 1990. You had, again, a steep drop of 14 to 15% in 2 months, followed by, it took a little while, but followed by a recovery into 1991 that was over 30%. So quick drop, took a little bit, a few months of turning around, and then all of a sudden a recovery. Couple more, 9/11. That was one that was, important in our lives. We were just starting off in this industry, or starting off in the work environment. Obviously the market was closed for a few days, but when it opened up after 9/11, it dropped immediately. It took a few months, but it did recover that portion of the decline, and provided some stability into the market. And then the most recent one was the Russian-Ukraine war that started in 2022. That market part of the S&P dropped about 8%, following the invasion and the conflict. Certainly had an impact on oil prices and other commodity prices. And like I said, oftentimes what you'll see is that quick initial drop, and then the market steps back, looks, hey, how is the economy doing? If the economy's doing okay, then typically this is just a one event, and usually that recovery will happen, relatively quick after this event. And much like, any kind of a recession where the markets actually start to recover before the conflict ends, or before the worst part of the conflict, you'll actually start to see the market recovery. Again, if the economy struggling a little bit, like it was in the Gulf War, where we were actually in a recession, or 9/11 when we were actually, in a big reset from the .com, might take a little bit longer. But if it's just a one kind of current event, the economy's humming along, and job markets are strong, company profits are strong, then yeah, it probably is just going to be a short couple of weeks, followed by a pretty quick recovery. And I think, again, we don't have a crystal ball, but that's at least what history has shown for us during these kind of human-made conflicts.
Would you say there's a statement out there, it's the market doesn't wait for certainty, it moves when uncertainty begins to clear? So would you say that a lot of the initial, like all the 6 that you just kind of ran through, the first couple of months, it's kind of like a shock in the market, right? And then investors step back, take a deep breath, and look at kind of the underlying foundation. So would you say it's, a lot of knee-jerk reactions at the beginning?
Yeah, that's a good point. I had a wise person tell me once that fear stands for false expectations appearing real. So all of a sudden you have this fear and these false expectations, and then when you realize that they're not real, then you have that sharp recovery. Mm-hmm. And I think that's exactly what you see, where it's just not, in those first few weeks where, hey, this is not going to happen. The worst of the worst of the worst is not going to happen. So let's start recovering, even though it might get worse. The news and the information, but the overall fear is not going to happen, and you start to see that recovery. You're right.
Yep. Well, very good. Well, let's kind of shift this to talk about the other thing that creates a lot of uncertainty around portfolios. And that's going to be, whether it's just politics in general or it's elections. I think specifically around election times is when a lot of fear kind of comes in. So I really want to take this from a place, of fear. And I think, what we hear, and I'm sure you guys would agree, what we hear from clients is we have a lot of clients that are Republicans. We have a lot of clients that are Democrats. And, both of them, I think on both sides of the aisle, we have people that come in and say, hey, if this party gets in, I think that the market's going to do really terribly, or I think it's going to do great, or vice versa. And I think, we all get that because I think politics is very, very personal to people. And they think it probably has more of an effect on the economy and on the stock market than it does a lot of times. So where it feels personal, I think for your portfolio, the data says differently as far as kind of how markets react. And I think what we want to do here is kind of go through, number one is presidential elections and who's in the White House and does that matter? And then also go through, midterm election years, because 2026, which we're in right now, obviously a midterm election year. And let's talk about a few kind of stats from that as well. But the big question is, does the party that's in the White House actually matter? And the answer is much less than most people think. And I think that's probably true. If you look at it, the S&P 500 has averaged 14% annually after dividends, regardless of which party has held the presidency. And there's really been no long-term bias between either party. Okay. And I think if you look at some of the strongest presidencies, meaning presidencies where the market has done the best, you have people from both sides. You have both parties, right? You have FDR, you have Clinton, you have Eisenhower, you have Reagan. They're all near the top as far as what the stock market did during the time they're in office. And I also think, and this is something that we hear from clients a fair amount, is that this time is different, right? This election is different. And by the way, I don't think we disagree, right? I don't think there's any doubt in my mind that there is more political divisiveness. It does seem like things are maybe a little bit more volatile politically than they've been. However, I would say in general, it's a trend for people to think this time's different, and it doesn't necessarily mean that it's going to affect the market in a different way. And a good example that we were all part of, I've been in the business since 2004, been through a lot of elections. A more recent one is 2020. I think people were really, really terrified of the full Democratic sweep. That happened. S&P rose 42% in the 14 months following that. I'd say even this last election, people were really worried on both sides if somebody got in that either the market was going to crash or it was going to run. Obviously, the Republicans pretty much won everything in 2024. And now here we are, with the market having a great year last year. So why is this? Okay. First of all, I think the fear is justified that people have, just in the fact that it is personal, but the data doesn't necessarily agree. And why is that? It's because a $28 trillion economy is driven by consumer spending, and it doesn't get re-engineered by an election. So inflation, interest rates, earnings, and economic conditions are what move the markets, not who's in the White House. And I think history has said that time and time again. And I think, obviously we can't predict the future, but there's a good chance that it continues to happen in that regard. So let's pivot a little bit and talk about specifically this year in a midterm election. So in 2026, every House seat is up for re-election, and about a third of the Senate is up for re-election. So midterm years in general have a well-known pattern, and it is worth knowing about. So we're right in the very beginning of it. But of the 4-year presidential cycle, midterm years are historically the most muted of the 4 in the cycle. And the S&P 500 averages just 5.8% in midterm election years. And in midterm election years, we have an average intra-year drawdown of 18% at some point before November. Okay. And so I think that's a good way just to brace clients and everybody that's listening to this is that if we have a big drawdown this year, which we may have one, and obviously anything can happen in any year, but if we do have a big drawdown, it's not necessarily based on politics as much as it's kind of how the market cycle and the election cycles work together to a degree. On the flip side of that, the year after midterms is historically the strongest of the cycle, where the S&P 500 has averaged 16.3%. So, and then the S&P 500 has never posted a negative return in the 12 months following a midterm going back to 1962. So I guess the point here is that it's not necessarily which party gets in, who wins the most seats. It's more just about the cycle itself. And what we've learned as well is a lot of times the choppiness in election years, whether that's a presidential election year or a midterm, is that the market doesn't really like uncertainty. But once that certainty, is there, and it doesn't really matter what the outcome is, it's just that the process is over. A lot of time the market moves in a positive way based on that information. So, so going back, I think that's good. Those are both really good scenarios of where a lot of fear comes in, times of geopolitical conflict, and then times of, domestic conflict, which we're just basically going through elections and parties are kind of butting heads on things. So, I think the natural progression here is, Ethan, let's talk about what our clients should do and what makes sense during times like this.
Yeah, I'll start with a quote that I've heard, I don't know, many years ago, and it's still, I think about it every so often. And it's that historically one of the biggest mistakes that investors make during times of crisis or market noise is they mistake volatility with permanent loss. And, you might turn on the news and the market's down 5% for the week, and they're thinking, the $1 million portfolio I had is down 5%. How am I going to recover from this? And you do, if history repeats itself, you do recover. It might not be the next day, it might not be the next month, but there is a long-term mindset that we need to have as investors. And so knowing that the market goes up every day and the market goes down every day, and those days switch quite often, it's not a permanent loss. It becomes permanent when you have those knee-jerk reactions and you call us or you go into your own portfolio and you hit that sell button. That's when you really cement that loss into your portfolio. So trying to weed out all the noise, to Jim's point, every time you turn on the TV, it's doom and gloom a lot of the time. So one thing that I practice personally is when we're in these transition periods or these times of crisis, I don't log into my 401k or brokerage account or anything. I just kind of let it be. And we encourage a lot of people to do that. You don't want to go blind every single year. We want you to log in and understand what's going on and call us with questions, but kind of letting things just go. And if it's out of our control, just understanding that and kind of looking at how we're positioned. So talking about opportunities and what you can do during these times, there's a lot of conversations we have with clients as they're becoming clients. And we talk about, risk tolerance and diversification, cash allocation and things like that. So if you're in retirement and you're using your assets as income for spending or vacations or what have you, you don't want everything to be invested in the S&P 500. You want diversification. You want a little bit of cash that's on the sideline. Some of our clients prefer to have 1 to 2 years of cash or money market or stable assets in their portfolio. So when we do have these periods of volatility, we don't really necessarily care what's going on in the market because we know that for the next 2 years, my needs are met. And we've got enough cash set aside that when the market recovers, we'll be okay and we can kind of live our lives. So positioning your portfolio and your overall financial plan is paramount. It's very, very important, especially if you're a nervous investor, aligning your financial plan with your risk tolerance so that when we do have these times of uncertainty, and we can sit down and review your actual plan with you. So if the market's down 10%, does that affect your lifestyle? And if it does, you probably need to go back and look at that financial plan a little bit better. So little things you can do along the way, staying the course. The hardest thing to do is when you log into your account or you look at the TV and the markets, everything's red. The hardest thing to do is to not react. And we get that. We're all investors as well. Not only do we help clients, but obviously we're invested in the market too. We understand that emotions run really high. When you bring politics into it and religion and other things that are out there that are really close to people's chests, emotions just can go haywire. And so calling us and talking to us about that, we encourage that, looking at history and kind of just taking a deep breath. We really want our clients to understand that. Things you can do on the sidelines, rebalancing. If you've got assets that are low and your portfolio is kind of skewed a little bit, you can rebalance. It's kind of forcing you to sell high in some assets and buy low in some other assets. So looking at opportunistic rebalancing. And if you're really aggressive and the market's down 10 or 15%, you've got cash on the sidelines, well, that's on sale. Realistically, if I go and look at a t-shirt that I really love and it's $40 and I know it's going to go on sale to $30 next week, I'm going to wait and I'm probably going to buy that t-shirt next week. Same thing goes for stocks. If I've got 100,000 sitting in cash on the sidelines and I really want to get into the market, do we put it in at all-time highs? Sure, we definitely could. But if we see a pullback and we see an opportunity there, I'd rather buy a stock at a 10% discount than something at its all-time high. So thinking contrarian a little bit and trying to not pay attention to your emotions, I know it's really, really hard to do, but those are little practical steps, little things you can do to try to get ahead of the curve.
I think
you're not going to hit a home run every time.
I think, Ethan, what I'm hearing you say there is you want to buy low and sell high, or you want to buy high and sell higher, right? That's
right. Yeah. Those two are never in sync with each other, right? But we want it. But that's the goal at the end of the day. Yeah. So
awesome.
At the end of the day, you think like, I'm 35 years old. I've seen some turmoil that's happened in the markets, but you look back at, when you're in 2005, think about, when you're in 2005 and you're an investor, you didn't know that 2008 was coming. And so living in that fear of always thinking, oh gosh, next year's the year, or the year after this is the year, recession's coming, living in that fear, you're never going to get ahead. And you're never going to let those assets do what they're supposed to do and let compound interest work for yourself, because you're always going to have that fear. So kind of just letting go of those things you can't control and focus on your savings rates, your diversification, and your financial plan. I think those are the three most important things you can do.
And when those crises do come, or those black swan events, because they're going to happen, right? Like we're going to have them. But that's when you focus on what we can control as investors, which is doing that opportunistic rebalance. If you've got cash, that's the time to dump it in. All those things that you've kind of already said, but that is, viewing those, trying to flip that script and viewing those as opportunities instead of, detrimental things is a really good mindset, in my opinion there. So,
yeah. And I think I've got a question for both of you guys, and I know I get this question a lot. I've got, a client will call in and say, hey, I've got cash. When's a good time to get in? Mm-hmm. And that's another thing that we want to stress to client. You can't time the market, entering or exiting. So, how would you guys approach that question when you get those client calls?
Well, I will tell, I don't know, Eric, if you want to go first or you want me to, but
yeah, go ahead.
I would say, because we get that question all the time, is people ask, is now a good time to get in the market? And my answer is always a question back to them is when do you need this money back? Okay. Because if you're investing this for the next 20 years, I would say every day is a good day to get in the market when you look at history. If you're needing this money in a year, or you need it in 3 years, well, then we might want to think a little bit, more carefully about, number one, do we get in the stock market, or do you do something a little bit more stable, and so on and so forth. And I think this could be a whole nother podcast is when we talk about dollar cost averaging. That's something that we've talked about a lot. And if clients don't know what that is, dollar cost averaging would be when, as opposed to if you gave us $1 million, as opposed to investing all $1 million, maybe we invest 100,000 of it each month for the next 10 months. And basically that, hopefully that smooths out the buy-in price. And what I'll tell you is there's a lot of data that shows that you're better off just buying into the market, right? As opposed to trying to dollar cost average in, because when you think about the stats of that, the market goes up 75% of the time. So a lot of times by delaying getting into the market, all you're doing is buying it at a higher and higher and higher price each month. And there are those times when dollar cost averaging works out. But anyway, that was a long answer to a short question. But I think there are some things that depend. But if you're a long-term investor, I'd say right now, this minute is the time to get in.
That's the answer I'll rule for.
Absolutely. And I'll just add, I mean, the work is on the front end, right? That's what you're doing. Before actually, clicking the buttons to make the buy. For us, it's to do the work on the front end and figure out those correct scenarios, or what kind of situations that we're dealing with, what kind of risk are we dealing with, before we just, go ahead and click the buy button. But, asking those questions is a good, that's the way to do it.
Going back to, the volatility thing and, thinking about the most successful people that when you ask them, how did you make all your money? It's not, I bought the bottom. Usually it's not bad. It's I was disciplined and I saved money when I could and I really had control of my savings rates. If you're making $200,000 a year and you're saving 2% of your income, it's probably not a lot. That's not going to make up for what you need in retirement. So you're not going to invest your way out of that. You need to look at what you can control, and that comes back to your savings rates, your diversification, and kind of how you've positioned your overall financial plan. So just think about those people that that are really well off and have done the right stuff throughout the years, and it's almost always never, I bought the dip. That's
Right.
usually not what happens.
They might have had a couple wins in there, but that's
Sure.
not what you know what I mean? That's not what drove it. I totally agree with that. And that's a super good point, because I think a lot of people do have that perception, right? The people that have a lot of the money, it was like a circumstantial thing that they did something right at the right time, but really it's that long-term savings discipline, not doing the wrong things when the market is acting up, and so on and so forth. So, well, very good, guys. This has been a good podcast, and hopefully everyone that listens to it gets a little bit of value out of it. And by the way, we'll see. Hopefully we're not in a war anymore, by the time people actually listen to this podcast, which will be, around 2 weeks from now. So this is Metcalf Money Moment Podcast signing off.
Thanks for tuning in to Metcalf Money Moment, the podcast. We hope today's episode provided valuable insights to help you unlock financial clarity, confidence, and peace of mind. For more expert advice and resources, visit metcalfpartners.com. Until next time, make every money moment count.
Jeb Graham, Ethan Hutchison, and Eric Wymore are registered representatives with and securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through WCG Wealth Advisors, a registered investment advisor. WCG Wealth Advisors and Metcalf Partners Wealth Management are separate entities from LPL Financial. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly.